All right, today we're going to pull back the curtain on a really fascinating part of a company's finances. It's a line item on the balance sheet that tells a huge story about investor confidence and a company's history. We're talking about the share premium account.
So, let me just start with a simple question to get us thinking. Picture this. A hot new company goes public. The official printed value on its stock certificate is just $1. But investors are so excited they're willing to pay $15 for that exact same share. So, where does that extra $14 go? Is it profit? Just cash sitting in a bank account? The answer, as you'll see, is way more interesting than you might think.
And that moment when a company first sells its stock to the public, well, it can be a massive financial event, a real IPO windfall. How a company accounts for all that incoming cash actually reveals a ton about the fundamental structure of its capital.
Okay, first things first, and this is super important. That extra cash is not profit. A company doesn't earn money by selling pieces of itself in the same way it earns money selling, laptops or coffee. Instead, that money gets classified as a very special type of capital. It's a direct contribution from investors, and it gets its own dedicated account.
So what do we actually call this special account where all that extra money lives? Let's get into the official definition.
It's called the share premium account. Now, heads up, you might also see it called additional paid-in capital or even contributed surplus, but don't worry, they all mean the exact same thing. It is simply the amount of money a company gets for its stock that is above its official par value. So, to really get this, we need to understand the difference between par value and what people are actually paying.
Par value is pretty much a historical, legal thing at this point. The best way to think about it is like the official price printed on a concert ticket, which might just be a penny or a dollar for accounting purposes. But the market price, that's what you actually pay for that ticket, right? It's based on how popular the band is. For stocks, it's the exact same idea. It's what investors are willing to shell out based on how much they believe in that company's future.
Okay, so that's the theory. But now let's make this real and see how the numbers actually work with a simple example. This is where it's all going to click into place.
So let's say our company decides it's going to issue 1,000 brand new shares. And after going through its IPO, the market is buzzing. Investors are lining up, willing to pay $15 for each and every one of those shares. And just look at the difference here. It's kind of wild, right? On the one hand, you have this tiny, almost symbolic par value of just 1 single cent. But on the other, you have the market price, what people are really paying, which is $15. That enormous gap is where our share premium is born. And this table just lays it all out so clearly. The company raises a grand total of $15,000. But here's the accounting magic. It doesn't all go into one big pot. Only $10, that's the 1,000 shares times that tiny 1 cent par value, gets credited to the main common stock account. The rest of it, a whopping $14,990, goes straight into the share premium account. So now the company is sitting on this pretty big pile of cash in its share premium account. But can it do whatever it wants with it? Go on a shopping spree? Well, not quite. There are some very specific rules to this game. And here is the single most important rule of all. This money absolutely cannot be paid back out to shareholders as a dividend. It's what's called a non-distributable reserve. And it makes sense, right? This rule is there to protect the company's core capital. It makes sure that the money investors put in to build the company stays in the company. So if you can't give it back to shareholders, what can you use it for? Well, it's generally used for stuff related to the share sale itself. A company can use these funds to write off expenses, like paying the big fees to the bankers, the underwriters, who managed the IPO, or to cover any commissions. It can also, in some cases, be used to issue bonus shares to the people who already own stock. Okay, so you're basically an expert now on what share premium is. But if you were to actually pick up a company's annual report right now, where would you even find this thing? Let's take a look. You're going to find it right in the Shareholders' Equity section of the balance sheet. And check out this quote from our source because it really drives home how important this is. It says that the share premium and retained earnings, that's all the profit a company has kept over the years, are usually the two biggest parts of a company's entire net worth. And this chart just shows it perfectly. Think of shareholders' equity as a pie that shows where a company's value really comes from.
You've got that tiny little sliver for the par value of the common stock, then a nice big slice for all the profits, the retained earnings. But very often, the biggest slice of all belongs to share premium. It's a direct, powerful measure of the faith and capital that investors have pumped into the business.
So you see, in the end, the share premium account is so much more than just a boring accounting entry. It really is a story. It's a snapshot of investor confidence, of the hope and the perceived value that the market saw in a company at one of the most important moments in its life. So the next time you look at a balance sheet, ask yourself, what story is it really telling you?